Hello, my name is Jason Mercer. I'm the Toronto Real Estate Board's Senior Manager of Market Analysis. Now, the housing market in the GTA has fared quite well despite stricter mortgage lending guidelines and an uptick in borrowing costs over the last couple of months. And so against this backdrop, we're going to talk about what we've seen in the market over the past year or so and what we expect to see going forward through the end of 2014. And to facilitate this, I've broken down our discussion today to cover 4 key points. First off, we'll look at the fact that home ownership remains affordable in the Greater Toronto Area. Secondly, we'll look at how home sales have remained strong and will continue to grow through the end of 2014. Then we'll look at how market conditions have evolved, and we'll see how market conditions have remained quite tight still on the low-rise side of the market, but not so much when we look at the high-rise or condo apartment market segment. And finally, we'll finish off with a look at price growth, where we expect the average selling price to go in the Greater Toronto Area over the next year and a half or so. Now, I'd like to start the discussion today with the concept of affordability. Quite simply, if we think about the reason why we're still seeing a respectable number of sales through the Toronto MLS system, it's because a household earning the average income in the GTA can afford mortgage principal and interest, property tax, and utility payments associated with the purchase of an average price home. And that's how we calculate affordability at TREB. We look at mortgage principal and interest, property taxes and utilities, and think about what share of the average household income before taxes is going towards those major home ownership payments. And so we want to think about this share over time, and that helps us sort of determine whether we're in an affordable situation or an unaffordable situation. And certainly over the last decade or so, all else being equal, home ownership has been affordable. We've seen that share of income going towards those major home ownership payments ranging between, say, 30 and 35%. And that's in stark contrast to what we saw during the late 80s and early 1990s when that payment was upwards of 50%. And that's why during that period of time we saw a protracted downturn in average home prices, whereas over the last decade and a half we haven't seen that. Even during the most recent recession, we did not see a calendar year decline in home prices, and that's because home ownership had remained affordable throughout that period of time. And it's also important to note that with that range between, say, 30 to 35%, that's still well below the recently federally mandated ceiling of 39%. And so it's important to note, though, the key driver of affordability, especially over the last couple of decades, has been borrowing costs. And so if we look at this chart here, this chart shows us the average monthly yield for the 5-year Government of Canada bond. And what we see is that's been trending downwards over the better part of the last couple of decades. Why is this important? Because the 5-year Government of Canada bond, or the yield on that bond, gives us a good idea of what it's costing lenders to raise money and then turn around to lend out to your clients in the form of a 5-year fixed mortgage. Now, over the last couple of months, we've heard a lot about increasing borrowing costs in terms of mortgage rates. And so we want to think about what's happened over the last couple of months to see this increase, and how will that impact affordability as we move forward. And so if we look at the highlighted portion of this chart, we can look at the next slide and sort of take a closer look at what's happened. So this chart essentially shows us a magnified version of the previous one, and it gives us an idea of that 5-year bond yield, but on a daily basis. And we can really see what happened in terms of that increase in interest rates over the last few months. And so really since the beginning of the year, there was the anticipation that south of the border, the Federal Reserve would be making an announcement saying that they would be pulling back on their quantitative easing program, which would have the effect of raising interest rates over the longer term. And so you started to see that 5-year bond yield start to inch upwards. And indeed, the Fed did make such an announcement on June 19th. And that's why you see that really sort of steep upward tick in the second half of June. But then in the ensuing month, we start to pull back from that a little bit. We saw that bond yield plateau and then start to trend downwards. And that's because the Federal Reserve made a second announcement saying that interest rates were expected to remain low, for the medium term. And certainly over the last couple of weeks, the Bank of Canada affirmed this view by also saying that interest rates in Canada, the Bank of Canada's policy rate, or the overnight lending rate, was expected to remain at its current level for the foreseeable future as well. The end result of that has been a renewed downward trend in that 5-year bond yield. And so as we look forward, we need to think about, where we expect to see interest rates going, specifically for that 5-year Government of Canada bond yield and how that'll feed through into that all-important 5-year fixed mortgage rate. And so if we think about what the market consensus view is for interest rate increases over the next, say, year and a half through the end of 2014, that consensus view is for about a 50 basis point increase from where we are today. So we're going to see that 5-year bond yield inching upwards a little bit over the next year and a half in anticipation of future interest rate hikes, both in Canada and south of the border. And so that brings us back to our affordability metric. And so we want to think about, well, how is that going to influence what share of the average household income is going towards those major home ownership payments, mortgage principal and interest, property taxes, and utilities? And we can do a bit of a sensitivity analysis in this regard. And so if you look at this chart and the red box surrounding that call out, that's sort of our baseline assumption. And so when we're measuring affordability at TREB, we don't assume the lowest possible interest rate that's in the market today. What we do is we sort of take a broad average of the posted rates offered by lending institutions that home buyers in the GTA would have access to. So year to date, we've been assuming about a 4% mortgage rate on the 5-year fixed this year. And so that's seen the average share of household income going towards those major home ownership payments at a little bit less than 32%. Certainly very affordable from an historic perspective. But it's realistic to assume that a lot of home buyers today are able to access a mortgage at a lower rate. Let's assume, say, 3.5%. And so if you took on a 3.5% mortgage today for the average price home, you'd actually be paying less than 31% of your income, if you're making the average income in the GTA, towards those major payments. And even if we saw interest rates or mortgage rates jump up by, say, 50 or even 100 basis points, we'd still see the share of the average income going towards those major payments below that 35% level. And so looking forward through the next year and a half or so, even if we do see some further hikes to that 5-year mortgage rate, we're still expecting the situation to remain quite affordable in the Greater Toronto Area. And that's why we're continuing to expect to see growth in home sales as well. Before we turn to our outlook for home sales and then price in the Greater Toronto Area, though, it's important to think about, well, what can that average price purchase today in the Greater Toronto Area when we're talking about different home types? So again, remember that our year-to-date average price as of mid-July 2013 was $522,000, give or take. So with this in mind, let's look at a map of the TREB market area to see where the average price for different home types has been at or below the average price for the GTA as a whole so far this year. This will show us where a household earning the average income could affordably purchase different home types throughout the region. So first off, let's look at detached homes. For starters, approximately 44% of detached homes have been sold at or below the average selling price of $522,000. We're mainly looking at the regions surrounding the City of Toronto, including Durham, Simcoe County, Orangeville, parts of York, Halton, and Peel, and there are a few districts within the 416 area code highlighted here as well. Now let's see how the map changes when we look at semi-detached homes. So 73% of semi-detached homes have been sold at or below the GTA average price. The geography of semi-detached sales is noticeably expanded compared to what we saw for detached. And so a household earning the average income could have affordably purchased a home in most of the 905 and 705 area code municipalities and about half of the districts within the City of Toronto as well. And when we switch the map to look at the situation for townhomes, we find that about 86% of townhouse deals were done for at or below the overall average price, and these deals took place in most GTA municipalities, save for now just a handful of districts within the City of Toronto. And finally, of course, when we turn to condo apartments, we find that over 90% of deals were done at or below the overall GTA average price, and affordable options were available in almost all parts of the GTA where we have seen condo development over the past couple of decades. So the bottom line after looking at these maps is home buyers within the Greater Toronto Area benefit from a great diversity of home types available across the region, whether you're talking about low-rise housing or high-rise housing. And again, that's why we're seeing still a lot of interest, because you can get into many different types of homes within many different parts of the Greater Toronto Area from an affordable perspective if you're earning that average household income in the region today. And so let's think about where we expect sales to go this year and through the end of 2014. And certainly for 2013, we're expecting to see sales a little bit above 86,000, and this is an improvement over our previous forecast. We saw the acceleration of sales a little bit quicker than we would have anticipated at the beginning of this year, particularly in the second quarter of 2013. So we have upgraded that forecast for sales, and that's passed through both into 2013. We're now expecting sales to be a little bit above 2012 levels, and we'll see them inch upwards again as we move towards the end of 2014. Now, it's important to note that when you think about where we're expecting sales levels to be, they're going to be a little bit above 2012 and a little bit higher again in 2014, but we're still going to be seeing those sales levels below the broader sort of long-term trend that we estimate using historic sales per capita. Now, part of the reason for that is that we're still sort of balancing out above trend sales that we saw earlier on in the new millennium. But what this also means that as we look forward, we would expect to see actual sales start to move back up towards that green long-term trend line, say as we move into 2015, 2016, all else being equal. Now, one of the reasons why we're still seeing sales below that longer-term expected trend is that some households are still being impacted by the stricter lending guidelines that came into effect midway through 2012. This is particularly the case with would-be first-time buyers, many of whom are still choosing to rent versus buying. And you can find, say in the downtown core and other condo nodes that have built up around the Greater Toronto Area, modern units with quality finishings and amenities that are close to an abundance of work and leisure opportunities. And so we've actually seen market conditions tighten in the condominium apartment rental market, with the rental to listing ratio up in the second quarter of this year compared to Q2 2012, and that fed through into an accelerated pace of rent increase over that same period of time. And so that's some of the reasons why we're seeing sales a little bit below the long-term trend. But at the same time, we are expecting to see sales increase on a year-over-year basis, both in 2013 and 2014. So that's the sales outlook for the remainder of 2013 and through the end of 2014. And now we want to take a look at what we expect in terms of price level and price growth over the same period of time. So we've covered off sales, but that's sort of only half of the equation when we're talking about price growth. We also want to think about the supply of listings in the marketplace and how the two, sales and listings, or supply and demand, have interacted to influence price growth. And so when we're looking at the relationship between sales and listings, one of the things we can calculate over time is months of inventory. Essentially, we're taking active listings and dividing it by sales in a given reporting period, like this chart here shows, on a monthly basis. And so the purple line shows months of inventory for low-rise home types, so singles, semis, and townhomes. And we see that over the last, say, 3.5 years, months of inventory has been at or below, say, 2.5 months. And really, anytime we're seeing that months of inventory indicator below 3 months, we can say that we're in seller's market territory. And when we're in a seller's market situation, we're seeing price growth well above the rate of inflation. And that's certainly been the case more often than not during this period of time, and certainly over the last couple of months, especially in the city of Toronto, we've seen strong price growth for singles and semis, double digit in some cases, over the last couple of months. Now that's been in stark contrast to what we've seen on the high-rise side of the market, where we've seen months of inventory trending upwards over the last couple of years. And that just gets back to the kind of new home development that we've seen in the Greater Toronto Area really since we turned over into the new millennium, and certainly since the recession. We've seen a lot of projects, a lot of pre-construction sales. Those are converted into construction, and finally they've converted into completed units. And as these units have completed, some of them have been listed for sale on Toronto MLS by investors looking to take advantage of market value increases over the construction period. So as a result, buyers have benefited from a lot more choice in the high-rise market as compared to low-rise. And so we haven't seen as aggressive offers for condominium apartments. And so we haven't seen as strong of upward pressure on pricing for condos versus the very strong upward pressure we've been seeing for low-rise homes, singles, semis, and townhomes. And the next chart bears this out. If we look at the trend, the price trend for low-rise versus high-rise homes, they're in stark contrast. We're seeing that purple line again for single, semis, and towns combined has been on a very steady upward trend, representing that above inflation year-over-year price increase. Whereas if we look at the condo apartment segment, we've seen that price trend basically flatline. We haven't seen any protracted decline in the average condominium apartment price, but it also hasn't been rising to any great degree either, sort of hovering in around, say, the 1% mark over the last few months. And so the condo market has held up quite well in the face of more supply, but we're certainly not expecting to see over the next year and a half or so any real change to the trend, either on the low-rise side or the condo side of the marketplace. And that gets us to our forecast for average price, both this year and for 2014. And so average price growth for 2013, we've actually upgraded the forecast. Initially this year, we were expecting to see an average price of about $515,000 for 2013 as a whole. And that would have represented about a 3.5% increase over 2012. We've upgraded this forecast to about a 4.5% annual rate of increase to about $520,000. And that's just because the low-rise side of the market has remained tighter than we thought it would, especially as we're looking towards the second half of this year. As we move into 2014, we're expecting to see continued price growth, and it'll still be driven by that low-rise segment of the market. But we are expecting to see a little bit more supply coming into the market in 2014 as households react to the continued sustained price growth really over the last couple of years. And so we will be seeing that average selling price edging upwards again to about $535,000. So with the home price forecast complete, a key closing point is that the housing market is going to remain affordable in the Greater Toronto Area for the remainder of 2013 and in fact through the end of 2014 as well, despite the prospect of increased borrowing costs as we move forward. And this is going to keep sales at a respectable level from an historic standpoint, and we're going to continue to see tight enough market conditions to exert upward pressure on the average selling price. Thank you very much, and I look forward to speaking with you again at the end of the next quarter.